Hi guys, welcome back to the channel. My name is Dave, and today I've got a 3-fund portfolio that if I was just getting started in the stock market, I would buy these 3 every single week. That's how much I believe that these can outperform the S&P 500. So I've done my research and I've done videos on these before. So I'm going to roll right into this and I'm going to show you how we would lay this out going forward. And now we're talking about the U.S. equity, U.S. stock market only. This isn't a complete portfolio, but I do believe these 3 can beat the S&P. So if that is what you're looking for, please stick around. Whoop. So if you're somebody out there that wants to just kind of set it and forget it and keep it really simple when it comes to the US stock market, this 3-fund portfolio might be right for you. So I've backtested this plenty against the S&P 500, think things like VOO or SPY, and over the last 3, 5, 10-year period, it just beats it consistently. And it trims out a lot of the fat in the S&P 500 and gives us that, better performance, which is what I've been looking for. So these 3 funds do exactly that. Not only that, but it also offers higher yield and a lower historical max drawdown. So all good things for the start of a new portfolio. So buy these 3 every week, and I think going forward that we should see superior performance as well. Now, this does not include bonds, real estate, or international exposure, so it's not a complete portfolio build, but if you're just looking for the U.S. stock market, this is a great way to get started. So let's look at these 3 funds and see how they hold up against the S&P 500. So let's jump right in, and please keep in mind, too, that I did study fund overlap, and I'll present that later on, because there's very minimal fund overlap between these 3. I mean, it would be easy to say, these 3 tech ETFs kick the butt of the S&P 500, but that's not the case. These are very diverse funds, 3 that do not overlap much at all. So my mix is, to beat the S&P 500, is SCHD, which is quickly becoming a YouTube favorite. You can see this one everywhere you go, and I reviewed it plenty of times. I'll link that up above. But this ETF focuses on dividend stocks and factors such as cash flow to debt, return on equity, dividend yield, and dividend growth rate. So if you're just getting started with investing in ETFs, this is a great fund all by itself to get you started. And it can serve as an anchor in any portfolio. And that's what it's going to be here. It's my anchor. So SCHD is my dividend value pick for this ETF soup that we're going to be building today. Now, next up is XLK, and this is the Spider Technology Select Sector ETF. This is my growth ETF that will provide exposure to things like Apple, Microsoft, Nvidia, and other growth stocks that people love and have grown rich because they've bought these things and held them over a long period of time. And finally, XLV, which is the Spider Healthcare Select Sector ETF. And this gives us exposure to the healthcare stocks that have historically outperformed the S&P 500. So with things like United Health Group, which has absolutely crushed the S&P 500 over the last 10 years. Wow, just see. I mean, look at that. That's some separation there. But of course, this does not mean that the next 10 years will be the same results. But these 3 are going to be our building blocks. And we're going to see how these can hold up going forward by adding them every single week to our portfolio. By the way, I have reviewed all 3 of these ETFs before, and I'll link them up above if you want to watch that for a little bit more in-depth information. But SCHD is the Schwab US Dividend Equity ETF, and I just want to run through each one of these really quickly as far as what the holdings are and what it focuses on, because the way I built out this portfolio when I backtested it was 50% SCHD and 25% in the others. So this is kind of my anchor, and you can alter those positions as well. So if you feel more passionate about having some more income and you want to invest more heavily in SCHD, you certainly could. And that way you're taking off a little bit more every single quarter through those dividends. If you really want to focus on growth, you can add a little bit more to XLK. So I do like that there's flexibility in this fund too. If you're just buying VOO every single week, there really is no flexibility if you're looking at the market in a certain way at a certain time. But SCHD is going to give us products like AbbVie, Pepsi, Coke, and UPS. So very focused on dividend and dividend growth. Healthcare is obviously something that we're always going to need, and that's why when I flash down through here and I see things like United Health Group, which actually has been on an incredible run, as I showed you, Johnson & Johnson, Eli Lilly, Merck, and AbbVie and Pfizer. And there's only a couple overlaps. These are a couple of them that you're going to see here that are also in SCHD. And then between healthcare and technology, there's no overlap at all. But this is going to allow us to adjust and put a little bit more into technology, things like Apple, Microsoft, Nvidia, and Broadcom that can just, help your your portfolio grow like a weed, right? So you want to be able to have that growth in there, and also maybe reduce that income if you're a younger person and have a little bit more growth focus within your portfolio. Now I want to take a look at fund overlap, and I think this is really important as an investor. So my goal here is to find different products that I can blend together that do not have fund overlap, but will also trim out some of the products that I don't necessarily want in my portfolio. So that's what I'm doing here. Now with XLV, we have 66 different holdings. XLK has 69, and SCHD has 104. So 239 altogether, but there are just 7 that actually have overlap. So we have 232 unique holdings. So I'm using ETFRC here. And between XLK and XLV, there is no overlap at all, healthcare and technology. But between SCHD and the 2 others, there is a little bit of overlap. So here we have SCHD and XLV, and you can see that there are just 4, AbbVie, Merck, Pfizer, and Amgen. So not too much overlap, but there are those 4, and that should be something that we should be looking at, right, and paying attention to, because SCHD will change its holdings over periods of time. Now between SCHD and XLK, there are just 3, and those are Broadcom, Cisco, and TI, or Texas Instruments. So it really looks strong when it comes to that, but you should be aware, how much Broadcom do I have between these 2 funds? Again, if you're going to buy just 3 technology funds and show me that you can beat the S&P 500, that's very different than what we're trying to do right here by studying fund overlap and seeing how we can beat the S&P 500 by trimming out some of the products that might not be right for us in the long term. And now we're going to jump over to Portfolio Visualizer here and check it out and see if what I'm saying is actually true. But this is a great website to backtest portfolios. So in this case, we're going to do a 10-year, 5-year, and 3-year test with $10,000 invested. We're not going to rebalance it at any time, and we're going to reinvest every dividend that we do receive. Now you can see each one of these tests will be SCHD, XLV, and XLK at 50, 25, 25 versus a 100% investment into SPY, or the S&P 500 Index ETF. And down here you can kind of see how that lays out. And here is our performance summary. So portfolio 1 to 2, and this is over a 10-year period. So you can kind of see the final balance. If you invested in this 10 years ago, you'd have 42,000 versus 34,000 with a compounded annual growth rate of 15 to 13. You're going to have a best year, worst year scenario there, and a max drawdown. So 21% versus about 24%. So in every situation over a 10-year period, yes, it actually beats it up. And if we jump over and do the exact same test over a 5-year period, we're going to find again that by trimming out that fat and focusing on these 3 ETFs at that weight, again, we're going to have better performance. So our $10,000 investment, again, is better at the end of that 5-year period. The CAGR's better. Standard deviation's better. Our best year, well, okay, we got slightly beat. Our worst year, though, is much better. Max drawdown is much better. So overall, 5-year period looks really strong. And then over a 3-year period, what do we have here? Scroll down, same thing. Portfolio 1 versus 2. Final balance looks better. So does our CAGR. Best year, worst year, and again, max drawdown, which for me, again, as a slightly older investor, as I continue to invest in these things, that's going to become more and more important. So 3-year, 5-year, 10-year, our portfolio is holding up really well and beating the S&P 500. So based on the past 10 years, this mix is pretty lethal versus the S&P 500, consistently beating it, not only for performance, but also for that max drawdown, which is important to me. Now, if you look at that dividend yield, doing a 50, 25, 25 mix, you're looking at about 2.21% versus 1.57% for something like SPY. That's a 40% increase. That's sizable, but I know a lot of people out there like, I can get so much more by adding JEPI and DIVO and all these other things. And you can definitely add that to a portfolio like that and make this part of your own portfolio as you build it out. But as a core, this looks really good. Now, what about going forward? How do you feel that healthcare, technology, and that core of SCHD will perform for you going forward? That's really important. That means you're kind of eliminating things like energy. I mean, you might have some of this in SCHD, but you're not going to have a lot of energy stocks or utility stocks. Industrial stocks are going to kind of limit some of those by having this approach. But those are the sectors that have consistently been outperforming that SCHD approach as well. it looks like a winner. Now, I will continue to build out this portfolio, but I do believe it has the makings of a very good approach to investing in the U.S. stock market. Now, it doesn't address things like bonds, real estate, international ETFs, things like that. You could really build out and say this is a complete portfolio build. But if you've got some ideas there, throw them at me and I'll continue to review these types of things. If you like this type of content, please like and subscribe. I really appreciate you watching. Have a great night. Take care. Woo!